IPO celebration masks a billion-dollar lie. Drew Houston grips the brass bell, smiling for cameras while cracks spread unseen beneath the trading floor. Behind the scenes, the numbers tell a different story. Dropbox valuation soars to $9.2 billion, making it the hottest tech IPO of the year. Yet, the real question lingers. How did a company that defied giants like Apple and Google find itself teetering on the edge of collapse just 4 years later? The IPO papers promised a future where Dropbox would dominate cloud storage, but the cracks were already visible. A core product that once seemed revolutionary was becoming just another commodity in a crowded market. The race to the bottom had begun. Flash forward to today. The stock price has plummeted, erasing billions in market capitalization. The once unshakable empire now stands on shaky ground, its glory days fading into a distant memory. But what went wrong? Drew Houston, once hailed as a visionary who dared to challenge Steve Jobs, now faces a daunting question. How did a company that defied the odds find itself in this predicament? The answer lies buried in financial secrets that few noticed at the time. The first secret is the commoditization of Dropbox core product. Google Drive arrived with 15 gigabytes of free storage, more than triple what Dropbox offered. Suddenly, the competitive edge that once set Dropbox apart began to erode, turning a once revolutionary feature into a standard offering. Monetization stalled as the company struggled to convert its massive user base into paying customers. Growth in paying subscribers flattened near 17 million, signaling a critical slowdown in revenue. The once fast-growing subscription service began to lose its momentum, leaving investors questioning the company's future. The third secret is an identity crisis that cost Dropbox dearly. Diversification efforts like Mailbox and Carousel failed to gain traction, and the company's attempt to compete in the collaboration space with paper was overshadowed by Google Docs and Notion. Each misstep chipped away at the company's core identity. By 2020, Dropbox had laid off over 800 employees, a stark reminder of the harsh reality facing the once thriving company. The stock price had sunk roughly 75% from its peak, leaving shareholders reeling and employees questioning their future. The empire was in freefall. The journey from NASDAQ glory to corporate crisis is a tale of ambition, missteps, and resilience. But what lessons can we learn from Dropbox fall? How can a company that once seemed unstoppable find itself on the brink of collapse? The answers are buried in the numbers, the missed opportunities, and the choices that went wrong. The story of Dropbox is more than just a cautionary tale. It's a mirror reflecting the challenges faced by countless companies in the tech industry. The question remains, can Dropbox rise again? Or is this the end of an era? In the shadows of Dropbox fall, a new chapter begins. The company's pivot towards AI and Dash promises a fresh start. But can it reclaim its former glory? The road ahead is uncertain, but the lessons learned from the past could very well define Dropbox's future. The tale of Dropbox is not just about the fall. It's about the fight to rise again, the journey from $1 billion valuation to the precipice of collapse. And now, the potential for redemption. What will the next chapter look like for Dropbox? As we stand on the precipice of Dropbox's uncertain future, one thing is clear. The story is far from over. The choices made today will shape the legacy of a company that once dared to challenge the giants of Silicon Valley. What will be the defining moment for Dropbox? It was a typical Boston bus ride for Drew Houston, a young engineer with a passion for making technology more accessible. As he rode to work, he forgot his USB stick, but his forgetfulness sparked an idea that would change the course of his life and the lives of millions of people worldwide. The idea for a file-sharing service that lived everywhere you did began to take shape in Houston's mind. He envisioned a system that would allow users to access their files from any device, anywhere, without the need for complex file transfers or storage solutions. Around the same time, a young Iranian-American engineer, Arash Firdausi, was walking away from an MIT PhD program to join a two-man startup, Dropbox, that had just been accepted into Y Combinator. Firdausi's decision to leave academia and join a startup would prove to be a turning point in his life and the history of the tech industry. The legendary 3-minute demo video of Dropbox, which spread organically overnight, exploding the beta waitlist from 5,000 to 75,000 users with zero ad spend, is the power of simplicity and innovation. The video's success was a key factor in the rapid growth of Dropbox, transforming a dorm room hack into Silicon Valley's fastest-growing consumer subscription service. Sequoia Capital's investment in Dropbox, which transformed a dorm room hack into Silicon Valley's fastest-growing consumer subscription service, was a turning point in the company's history. The capital infusion allowed Dropbox to scale rapidly, expanding its user base and solidifying its position in the market. This is just the beginning. Subscribe to see more amazing content. Fire. Steve Jobs sat across the table and dismissed Dropbox as just a feature, not a real product. Houston refused to sell his company, knowing that independence was worth more than any nine-figure check. Reports surfaced that major tech giants wanted to buy the startup, but Houston pushed the money away. He knew that losing control meant losing the vision for a truly open cloud platform. While Apple and Google built walled gardens, Houston focused on syncing files across every operating system imaginable. This neutrality became the genius strategy that attracted users tired of being locked into one ecosystem. The neutral platform strategy worked, and the user base exploded past 500 million registered accounts. Investors saw the potential, and the company hit a $1 billion revenue run rate in record time. Competitors tried to trap users inside their own ecosystems, but Dropbox remained the open door. This utility-first approach proved that a neutral service could actually outpace trillion-dollar tech platforms in user adoption. Jobs famously told Houston that Dropbox was a feature inside Apple's ecosystem, not a product of its own. The insult stung deeply, but it also clarified exactly what Houston needed to fight for. Rejecting the buyout offer was not just a business decision. It was a declaration of war against platform dominance. Houston wanted to build something that existed for the user, not for a single device maker. The software engineers built a seamless sync engine that worked flawlessly on Windows, Mac, and every mobile device. This technical mastery allowed Dropbox to become the essential bridge for professionals working across different worlds. The year was 2012. Dropbox servers hummed with confidence as they synced files for millions, until a quiet rival emerged. Google Drive launched with 15 gigabytes of free storage, more than 7 times Dropbox offering. This wasn't just competition, it was a death sentence for their core business model. Drew Houston had built Dropbox on the promise of seamless file access. Anywhere, anytime. But Google didn't just offer more space, they weaponized it. Their free tier wasn't a courtesy. It was a trap, luring users away with promises of convenience while quietly eroding Dropbox's competitive edge. The war hadn't even begun, but the battlefield was already shifting. Behind closed doors, Dropbox leadership team scrambled. Their early mover advantage was evaporating. The free storage war wasn't just about gigabytes, it was about trust. Users who started with Dropbox could now leave without missing a beat. The company's entire value proposition was being dismantled, brick by brick, by a rival that didn't even need to sell them anything. Financial filings painted a grim picture. By 2018, Dropbox paying subscribers had plateaued near 17 million. Hardly the explosive growth they'd once promised. Revenue growth, once soaring above 30% annually, had collapsed into the low single digits. The engine that had powered their rise was sputtering, and no one seemed to know how to restart it. The diversification bets Dropbox had made to stay ahead were backfiring. Mailbox, their ambitious email app, was shut down after failing to compete with Gmail. Carousel, their photo-sharing experiment, fizzled out against Instagram and Facebook. Even Paper, their collaboration tool, lost the war to Google Docs and Notion. Every side bet had become a dead end, leaving Dropbox stranded in the middle of nowhere. The layoffs came in waves. 2020 saw the first cuts. Then 2023 brought another wave, trimming over 800 roles. The company that had once been the darling of Silicon Valley was now slashing its way back to survival. Every round of layoffs was a desperate attempt to stay afloat in a sea of declining revenue and mounting debt. The stock market didn't care about excuses. Dropbox shares, once valued at nearly $9.2 billion, had plummeted by 75%. Investors had lost billions. And the company's once unshakable reputation was now a cautionary tale. The fall wasn't just financial. It was a collapse of confidence, a betrayal of the promise that had once defined them. Drew Houston stood at the helm, staring at the wreckage. The company he'd built had become a cautionary tale, a lesson in what happens when you ignore the shifting sands of the tech industry. The storage war had won, the diversification bets had failed, and the once unshakable empire was now fighting for its life. The question was no longer how they had fallen, but how they would rise again. The layoffs had been brutal, but they weren't the end. They were the first step in a brutal strategic reset. Dropbox had to reinvent itself, or risk becoming just another footnote in the history of tech's greatest failures. The question now was whether they could turn the page, or if the damage was too severe to repair. Inside the boardroom, the debates were fierce. Some argued for doubling down on storage, others for pivoting entirely to AI. The one thing everyone agreed on was that the old playbook no longer worked. Dropbox's future wasn't in what they had done before. It was in what they could do next. The clock was ticking, and the window for redemption was narrowing with every passing day. The financial strain was visible everywhere. Dropbox's cash burn was unsustainable, and the market was no longer patient. Investors were pulling back, venture capital was drying up, and the once revered brand was now seen as a cautionary tale. The company's survival depended on a single, desperate gamble. Could they reinvent themselves before it was too late? The decision was made in secret. Dropbox would pivot not to storage, not to apps, but to something entirely different, something that could turn their weaknesses into strengths. The question was whether they could pull it off before the industry moved on without them. The stakes had never been higher. The pivot was bold. Dropbox wasn't just changing direction. They were redefining their entire purpose. From a file-sharing giant to an AI-powered productivity tool, the transformation was radical, but change was the only constant. Could they pull it off before the market forgot what they once stood for? The first whispers of the new strategy spread like wildfire. Dash, the AI-powered productivity tool, was more than a product, it was a lifeline. For a company that had once been the king of file sharing, this was their shot at redemption. But failure was a given. Could they finally turn the tide? The road ahead was uncertain. Dropbox had fallen from grace. But they weren't gone. The question now was whether they could turn their greatest failure into their greatest comeback. The world was watching. The clock was ticking. And for the first time in years, there was a glimmer of hope. In the heart of Silicon Valley's golden era, Dropbox wasn't just a company. It was a cautionary tale written in code and cash. Its rise was meteoric. Its fall a slow unraveling of what happens when brilliance becomes a commodity. Today, we dissect the lessons every builder and investor must heed. Dropbox's genius lay in solving a simple problem: how to sync files across devices without losing them. But here's the flaw. What started as a revolutionary feature became a standard feature. Google, Microsoft, and even Apple could copy it, and they did. The moment a giant can replicate your magic, your moat turns to mist. Dropbox's early success masked a dangerous truth. Their core product was being commoditized. The race to offer more storage, faster syncs, and better security wasn't about innovation. It was about slashing prices until the leader was left with nothing. This is the silent killer of tech empires. Turning your crown jewels into a commodity, investors poured billions into Dropbox, betting on a company that seemed unstoppable. But the real red flags were buried in the fine print. Net revenue retention began to weaken, signaling that customers weren't sticking around or weren't growing as expected. This is where the story gets chilling. Deceleration is the first whisper of collapse. Behind the scenes, Dropbox's stock-based compensation was quietly diluting shareholder value. Employees were rewarded with equity, but the company's stock price was plummeting. This created a vicious cycle. More stock was given out to retain talent, but the value of that stock kept dropping. It's like printing more money to pay debts. Eventually, the currency loses all worth. Dropbox leadership faced a brutal choice. Keep chasing vanity growth or pivot before it was too late. Vanity growth means expanding revenue at all costs, even if it means diluting profits or alienating customers. But disciplined reinvention means cutting unnecessary expenses, focusing on what truly matters, and preparing for the next wave. This is where most empires fail. They confuse speed with strategy. In 2020, Dropbox made a radical move. They cut over 800 roles. This wasn't just cost-cutting, it was a strategic reset. They stopped chasing every shiny opportunity and focused on what they did best, making file storage reliable, secure, and seamless. The result? Hundreds of millions in free cash flow, and a bold decision to buy back their own stock. By buying back their stock, Dropbox sent a powerful message. They believed in their company's future. This wasn't just an accounting move. It was a vote of confidence in their ability to reinvent themselves. Tech giants often chase growth at any cost. Dropbox chose capital discipline, and that discipline became their secret weapon. The year 2024 brought Dropbox's boldest move yet. The introduction of Dash, their AI-powered assistant. This wasn't just another feature, it was a genuine second act. By reframing their core product with AI, Dropbox didn't just survive. They redefined their entire story. This pivot proves that resilience isn't about never falling. It's about getting back up and building something even better. Dropbox's journey teaches us that the difference between success and failure often lies in one critical question. Are you building a feature, or are you building a moat? A feature can be copied. A moat protects your kingdom. The companies that last aren't the ones with the best ideas. They're the ones who understand what ideas are worth protecting. The story of Dropbox is more than a cautionary tale. It's a masterclass in resilience. It's about recognizing when your moat is eroding, when your growth is vanity, and when it's time to reinvent. The companies that thrive aren't the ones that never fall. They're the ones that fall and then build something even stronger. And that's the ultimate lesson in business. Discipline, not just speed, is what builds empires. But here's the question that keeps you up at night. What's the one feature in your business that could be copied tomorrow? And what's the moat you're building to protect what truly matters? The answer might just save your empire. What is the dark truth behind this event? Share your theory below and watch our next investigation. Welcome. Before we begin, hit subscribe so you don't miss our daily updates. Tomorrow's video will reveal this secret. Subscribe so you don't miss it. Shushing face.